The speculators are currently playing with fire.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. This is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and I'm here right in the vault, and I'll be your host this week. And we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver markets and expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge and understanding that mainstream media just will not provide. So just before we head over to the UK, please help us spread the word about this channel by hitting that like button right now. Hit the like button, share this information, and also if you haven't already subscribe. And if you have subscribed, you might want to click on that bell right there, and you'll be notified as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, just before we started recording here, you had mentioned how over the course of September, the COMEX speculators made massive bets against the house, and how these automated paper market bets against the gold have really stretched the paper market to disconnect from the physical market. We've been talking about this for a long time here, but is this a major inflection point? We really haven't seen this since the BIS covered all of their shorts way back in November of 2022. Can you comment on this?
Yeah, Shane, great to be with you. Great to be with everybody. So much going on. Obviously, just look at the charts. Look at the September action from the moment September opened until really the end of the third quarter on Friday, and a bit of a carry through. So let's really throw some light on this. And yeah, Shane, we're going to look at this. This is a huge opportunity, and we'll look at this in detail shortly. And while these naked short speculators chase a dot on a screen, there's nothing other than a dot on a screen to these guys. What they don't see under the smoke and mirrors synthetic action is what the cartel sees. And of course the cartel is long against them, i.e. the speculators are selling gold and the cartel is buying it against them. And they're doing it at an unprecedented physical market disconnect. You just talked about this paper to physical disconnect. It is unprecedented. And there are two real unfactored physical gold drivers that will force the house to revalue gold before the market causes a COMEX default. Now, one is the Russia oil for gold barter trade, and the other is for a revisit to the China gold trade that we covered in the spring, which is completely off the radar. And I'll start with Moscow. In our last episode, and last couple of episodes, we drew attention to the consistency of the unreported over $40 an ounce gold Moscow exchange premium being offered into the COMEX-driven paper gold generated sell-off. Now, by the way, that premium expanded to close to $50 on Friday, and despite gold coming off its lows this morning, has stayed elevated above $40 an ounce since then. And by the way, we're recording this on Tuesday, and this will be published on Friday. So just bear that in mind. And it's also important to differentiate that while the Moscow futures contracts are physically settled, COMEX-driven gold is paper settled and is not deliverable. And therein lays a massive paper-to-physical arbitrage opportunity for friendly countries easily able to access the increasingly liquid oil for bullion trade, which, even accounting for friction, essentially provides about over a $30 discount for oil, which can be arbitraged right back into the global oil markets. This is a hugely attractive trade. And in the meantime, what it's doing is sucking bullion out of the system. Now, the gold for oil trade effectively circumvents Russian sanctions. But our focus is that at the margin, and this is so important when you have leverage against unleverage, these global bullion outflows flowing into Russia are draining sufficient physical gold from the wholesale global markets to seriously deplete immediately deliverable global bullion supplies at current prices. That is, I mean, this is the point. There'll be gold available at some price, at a hell of a lot higher price. But you start to play games with the paper price, very little comes on offer. And interestingly, at an end of quarter meeting over the weekend, it was indicated by one of our extremely well-connected first-tier liquidity providers that the current counterintuitive gold sell-off that began on the first trading day of September was very likely an official pushback against this extremely disruptive, sanction-busting oil for gold trade, and a factor that has driven the most aggressive official paper gold market intervention since gold bottomed at $1,618 back in November 2022. Now, in fact, liquidity providers see a very close parallel to when the Fed was forced to capitulate the March to November paper gold sanctions pushback. If you remember, that sell-off started as soon as Russia gave a grand price for gold for this oil trade, for the energy trade. And immediately we saw this massive sell-off, and it capitulated in November. And guess what? By then, every single bullion bank, including the Bank of International Settlements, as you just rightly said, Shane, went long physical gold against the Fed, evidencing gold bottoming out, in fact, at $1,618. Now, every single insider is accruing physical gold. Every speculator-induced gold rinse downwards is being capitalized on by central banks and bullion banks for their own book. Now, we're recording this episode on Tuesday, I say, and while we would expect the paper-settled inverse COMEX algos to weigh on fiat gold and silver into global yields that have actually risen to record levels and powering the dollar index to the 30th of November 2022 highs at 107.195 last night, the intensity of the paper gold sell-off has far exceeded the balance between where the leveraged paper market runs head-on into an as yet unrealized, unleveraged competing physical gold buyer. Now, and we're talking about buyers. And once again, the Fed sell lever has actually relied upon driving leveraged cash-settled gold selling. And of course, what they've done is induce the selling by the captive speculators, which are siloed inside the COMEX exchange. And once again, the US-centric focused gold attack is 100% conducted in the paper markets with zero, and I mean zero physical gold put on sale into this rigged discount. In fact, liquidity providers report quite the reverse. And although yet to feed through, the dip below 1900 spot gold had triggered the very large weighting. If you remember, we said there was central bank Sino-Russian orders sitting there, as well as other central bank orders. And that is what we call a T+2 buy, where you buy the physical and on the spot markets, and then it has to be delivered within 2 days. So yes, but this is what we're dealing with here is unleveraged physical meeting leveraged sales. So there's a bit of a lag, it appears. But under the radar, these T+2 orders that were aggregated at 1900 and below are capitalizing on the officially conducted gold raid, just as they did all the way into November of last year. And in our last episode, we looked at how leverage can work for you or against you. And the leverage overshoots will force insiders exposed to physical market delivery obligations to short cover. Momentums are always wrong at both ends of a trade, and the speculators are currently playing with fire.
Wow, that's fascinating. Now, Andrew, you mentioned China. Can you tell us what you're seeing there?
Yeah, Shane, happy to do this. Let's just revisit what we're seeing now and also update our China threads, which we started in the spring. And just ahead of China moving into their first week, the 1 week golden holiday last Friday, and they're obviously absent, it was no coincidence that the PBOC opened up the import spigot into the dips sub 1900. There was no coincidence there. And with that in mind, with China away for Golden Week holiday, let's actually revisit and update what we're hearing from our very well-connected Chinese contacts. Now, back in March, we looked in detail at the second large push by the PBOC to add a click of the mouse physical gold purchase facility to everyday citizens. So, in other words, they have an RMB bank account with a mouse there to click, and they do their banking on it. And what it did was open gold up as one of those options, making it easy for less wealthy citizens to be able to convert RMB into physical gold. Now, and just as they did in their first well-published 2010, you remember the TV and billboard marketing push, massive billboards the size of houses on the side, buy gold. I mean, this was focused on incentivizing the wealthy citizens to purchase bullion bars and coins. This is like size. And the second and wider reaching gold accumulation push this year has focused on incentivizing the less wealthy masses to regularly invest in gold grams. Now, this is where it gets interesting.
Now, Andrew, from what you were saying, like the scale of what you're talking about here is absolutely staggering. Can you run through it for our Live from the Vault subscribers?
Absolutely. Shane, let's just put the scale of this into context. This gold investment scheme is open to all 1.4 billion Chinese citizens. Now, the average savings rate is around 30 to 40%. And with the PBOC incentivizing gold into this RMB saving mix, it is suggesting citizens convert at least some of these RMB cash into physical gold every single month. Now, let's just think about it. Look, if just 10% of the population bought a single gram per month, that would on its own consume 1/3 of global supply for gold in just 1 month. And let's be more conservative. If 10% of Chinese citizens converted a single gram just once into the Lunar New Year in 2024, which is their gold buying season, it would consume 1/3 of global gold supply. Now, so putting that into context, people don't think about this. So the question is, where would this excess bullion supply to feed this trade come from? The answer is it would have to be sourced out of immediately deliverable above ground supply, global supply. And at what price? Well, the answer to that is certainly not a paper price. And first-tier bullion banks exposed to this radically changing supply-demand imbalance, they're aware of this. And they're aware of the impending supply-demand imbalance. And they are gearing up for a much higher gold price, and are long for their own books. Now, the gold price will actually be determined by a physically settled supply-demand balance. I mean, in other words, the price a global seller is actually willing to part with their physical gold in exchange for either cash or other goods, such as commodities. Now, in other words, the only remaining paper-settled futures market, which is the COMEX, would have to become deliverable, or it would be raided for every single last leverage ounce it has in its system. US traders currently siloed inside this rigged CME regulated, self-regulated paper market would have to actually be released from their siloed prison, and the 50-year margin game will fold. Clearly, if you're no longer leveraging gold, why would you not let them access physical? And as we highlighted last time, while muscle memory conditioned paper gold market traders focus on a lack of arbitrage opportunities between the siloed COMEX exchanges and the physical Chinese markets, they miss the effect that these Chinese bullion drawdowns, all sourced from a single supply of around 3,000 tons a year, are going to require a substantially higher equilibrium gold price. And they miss that the global paper to physical arbitrage opportunity is actually upon us now. The effect of this fresh Chinese demand is going to have on the gold price it's going to be priced globally, and it has to be priced globally, and is definitely not understood or priced in at all. Now, both the 2010 and this most recent 2023 PBOC mandate to incentivize citizens to invest in gold were pitched on the basis that these gold investments would rely solely on a rising gold price. And as was conducted in 2010, and again following this year's latest push to incentivize gold investments, the PBOC have underpinned these RMB denominated entry prices. They are going to protect their citizens. And for reference, at the point the PBOC instigated the first 2010 physical gold marketing push, the equivalent COMEX generated gold price was 1,045. And despite the continuation of the 50-year official Western Central Bank paper gold suppression efforts, and we covered this in detail last time, most notable, if you remember, was the $500 officially driven paper market intervention, which was undertaken directly after, on April the 1st, 2013, we talked about this last time, the Presidential Working Group stepped in to bail out the LBMA banks. Why? Because they were caught naked short into a rising gold price, unable to fulfill actual client bullion redemption requests. So what we're drawing attention to is, though, that despite all of this, and after China stepped in with this gold marketing effort, the Western paper-driven gold price was never able to be driven back below 1045 again, 1045. It was no coincidence that gold turned exactly at 1045 on the 1st of December 2015 into much later reported very large PBOC demand, which of course is only partially reported. So monetary gold does never get reported.
Now, Andrew, in our last episode just 2 weeks ago, you also looked at the PBOC, and you were saying that the PBOC had once again been closely managing the RMB price of gold. Can you update us on this?
Yeah, and this year's PBOC marketing efforts to incentivize all citizens to buy gold was benchmarked at the Western diluted gold price at plus or minus 1,950 to 2,000, because it's a volatile market. And up until the commencement of the Chinese Golden Week holiday thinned out liquidity as they exited last Friday, the SGE had evidence a premium that really closely mirrored the equivalent US dollar denominated entry price of around 1,950 to 2,000, with the SGE has at times commanded over $120 per ounce premiums over Western denominated gold. But actually, let's clarify this. While we look at these Western market differentials to provide really larger picture context, in the shorter term, due to the siloed nature of both the CME and the Chinese markets, these premiums will fluctuate inside their various siloed exchanges. Now, while the latest officially driven paper-driven gold market intervention undertaken into this last third quarter, last Friday, and carried through a little bit in the last day, That jived with the PBOC opening up. It's interesting, this. It jived exactly with the PBOC opening up import quotas, allowing more bullion to enter China, thereby reducing the premiums to still elevated but much more normal premiums. Now, this contango contraction was really largely due, as I say, to the PBOC sanctioning more global gold imports into China to assist in meeting, get it, very, very strong Chinese demand. So from a wholesale market perspective, there is two things that really have our attention here. One is the impeccable timing for the PBOC to sanction increased quotas for Western paper market discounted bullion imports into thin liquidity just ahead of the Golden Week holiday. And look at the prices. And this is important. The bullion, the second really reason and really important, is the bullion flowing into China is being sourced out of the fractionally held paper diluted Western markets, which are already experiencing very tight global physical supply. And when aggregating these fresh Chinese imports with the increasingly large Moscow gold for oil barter trade, which we've recently drawn public attention to as well, and that is all feeding on global supply, again, at the margin, the end of the quarter paper-driven sell-off, which has incentivized follow-through leverage spec selling, has stretched the paper to physical divide to extremes in excess of that experienced in November 2022 when gold was trading in the 1600s. Now, this fresh T+2 physical delivery demand is unleveraged and has yet to hit the market, making COTs reliant on squaring off these undeliverable COMEX-driven paper market short bets, which have to be closed before they actually leach out of the back door of the casino into the deliverable net stable funding ratio Basel III compliant global spot markets, where they are deliverable. Obviously, the COMEX tail wags the physical dog, but some of it flows out. And if you can't settle it inside this siloed casino, this is deliverable. And as we highlighted in previous episodes, the PBOC is able to support Chinese jurisdictional RMB gold pricing due to the siloed nature of the Chinese gold market, which operates on the inverse mirror image of the siloed COMEX market, which conversely is designed to do the exact opposite, namely to cap the price of gold in support of the dollar. Now, while both markets are siloed, they are both ultimately feed on just one single supply of immediately deliverable global bullion. And that is missed by many, many people who think the arbitrage process isn't underway. It is in a much larger scale. And the COMEX paper gold pricing mechanism really relies on restricting the US-centric commodity trading advisors and traders it restricts them from directly accessing the Basel III compliant, physically backed first-tier delivery markets. And this is achieved by locking them inside the carefully controlled, fractionally backed COMEX paper-settled gold market, where participants are encouraged to borrow highly leveraged non-delivery paper gold positions at a fraction of their value from the controlling house who hold the loan book on them. Hence the analogy of a casino where the odds of the house winning against the specs are 95-1 and carefully regulated. And the ability to rig the paper settled price relies on speculators taking these bets against the house holding the book on their borrowed bets. Think about it. Without this group of traders, price rigging would not be possible. Now, in this case, when they start borrowing longs, you know very well you start to get worried that they're going to take a rinse. When they've sold it short against the house, what do you think the house is going to do? It's going to ring the register at some point. And it's exactly where that point, where the lines cross. However, unfactored, massive Chinese physical demand is competing with the Moscow oil for bullion trade, and this aggregated physical bullion demand is, again, at the margin, very important. It's sucking out stocks of fractionally held bullion, which is underpinning the rigged-capped Western gold pricing mechanism. And under the smoke and mirrors action, we're currently evidencing, you have to look at the charts from the 1st of September, the scale of the paper to physical market disparity is so large, it is negatively impacting Western liquidity providers' attempts to balance out both markets. And that's where we are now. And as a backdrop to the latest push to incentivize citizens to buy gold in the larger picture, President Xi Jinping has implemented the largest military buildup since the Second World War. And while he hopes to stand his ground against the US hegemons and to find a peaceful Taiwan integration, playing the long game, as a hedge, China is mobilizing its civilian population for war. And this means he has to sanction-proof his regime for an increasingly weaponized dollar, potentially providing access to the additional 26,000 tons of gold held by citizens who would be rewarded for participating in a significantly higher gold price. So that's accessible. This is all, if you look at all the pieces of the puzzle, it all makes sense. And this process is underway, and it will place a strong bid under physical gold. And if the COMEX-centric paper market does not follow, continuing to sell undeliverable futures contracts to try and cap gold into this unfactored swap of dollars for gold, which is coming through from the rest of the globe, the COMEX will be drained of all its leveraged NSFR-compliant bullion through the EFP conduit. We've talked about that before. It is simply a mechanism where you can take the bullion out of the COMEX if you're of a sufficient size. You can actually take it out and literally convert it into a deliverable contract, which is happening.
Andrew, that's absolutely fascinating. For the last, 100 and some odd episodes that we've done, we are always saying physical versus what? The paper, the casino. But can you tell us what's happening here in the very, very short term?
Yeah, and very short term. Following September's officially driven third quarter slam down, the sheer scale of this paper to physical disconnect has reached really untenable levels. And at the margin, again, is undoubtedly going to force Western paper market deleveraging. Now, outflows of physical gold underpinning the fractional amount of US-centric gold are unseen by the blinkered speculators who are just auto-selling fiat gold against a rising dollar simply by an algorithm that says buy dollar, which is fiat, sell gold, which is fiat gold, because it's not real gold. So it's a simple little game. Now, as far as the inverse dollar gold algos are concerned, the ones that we just described, the end of the third quarter ramp in the dollar and the yields has driven a mass capitulation of paper market long bets, paper gold bets, and ramped up short bets, i.e. people who are saying, hey, I bet lower and I'll just chase this dot down. And they are driving the COMEX paper to physical disconnect to absolute extremes. And as we mentioned earlier, the ramp in treasury yields alongside global yields hitting record highs has driven speculators to race into cash and the dollar, reaching November 30, which the dollar has reached these November 30th highs. And we saw that happening overnight. And to provide context, on November the 30th, gold futures were trading at 1,758. Although it bottomed in the 1,600s in November, actually on the 30th, this is where, and we're trying to apples, dollar price to where gold was at that point, 1,758. Illustrating, though, the paper market bleed out of this inversely correlated algo. And also, we were benchmarking silver at 21,355 on November the 30th. So just to provide a little context. And following the end of week meetings with first-tier liquidity providers over the weekend and again last night, despite hawkish Fed spin driving yields and the dollar index higher, the consensus is the rise in bond yields is perceived to actually be taking pressure off the Fed's current hawkish spin. So really, again, just automated selling based on headlines, and really no one looking any deeper. And as a wall of long, this is important, a wall of long T+2 central bank spot gold positions will now have commenced the NSFR delivery process. And the spec long clean out has led by the spec long clean out and led by the nose, these long dollar short gold positioning has provided the Fed some very large short cover into this raid. But while very short term, these official short bets have been largely squared off inside the non-delivery COMEX exchange against the specs, on the other side of this trade, liquidity providers holding offsetting longs in the spot delivery markets will be forced to deliver physical gold against the spillover of very large unwind of leveraged sales. Now, with non-sticky speculators largely capitulated. Now, remember, there are some sticky speculators, commodity trading advisors, who recognize that even paper gold has become a first-tier asset class. So really, they don't get rinsed. So it actually reduces the amount of bandwidth that the insiders get to play with. And even though they've borrowed these positions from the house, they're doing it's a function. They are actually a hedging function. So they're not easy to rinse out. But those with the non-sticky specs capitulated, all their longs are gone. The downside is being driven by fresh dollar index backed naked short spec positions, which are vulnerable to the house who are betting long against them. Insiders exposed to this offsetting imminent T+2 delivery obligation will be looking to buy back what they can to offset the resulting unwind of paper market leverage, while momentums will likely try and chase the paper gold lower. November capitulation limits are pretty much evident, and footprints evidence insiders are already positioning long. Now, I'll have more information on the at the margin all-important Sino-China trade by the next episode, including a significant progress update on the adoption of Glasniev's gold-backed commodity currency. But there is little doubt that gold and silver have to undergo very large short covering into fresh highs for the fourth quarter. Now, that's pretty much what we're seeing very short term.
All right. Now, Andrew, you noticed something very interesting in the watered down COMEX COT report. I think it would be really of interest to the whole community if you told us your thoughts on what you noticed here.
Yeah, and I don't usually look at this report because it just looks at one side of the equation, but actually it gives us a little clue. Obviously, the outdatedness of this 3-day-old COT report when it was published on Friday, well, obviously, it's going to be a week old by the time the next one's published, because it was cut off on Tuesday, the 26th. I mean, this is ludicrous when that information is available every day. But still, this report, which is the CME report, it still hadn't yet captured the very large end-of-month gold and silver market selling. And given that the insiders, specifically the swap dealers, the predatory swap dealers, were positioning long for higher prices and the price crashed, it looked like the predatory swap dealers were not expecting the degree of the officially instigated sell-off. And that confused a lot of analysts. The house, the agent bank insiders, they're privy to official intentions and rarely miscalculate positioning. So why did they show they'd added 61 tons of long position into what they knew was a 3-day sell-off? It was because they had to buy back COMEX shorts, hedging central bank buying that hit them between the eyes as soon as the COMEX tail wagged the $1,900 spot level, triggering, guess what, 60 tons of central bank orders that we'd identified as waiting for such an event. So That's the answer to that. And what's becoming much more apparent is since NSFR conditions were brought into play in January, it's impossible to view the COT report without weighing in the long, physically backed hedges backing up the remaining. There's 108,000 odd net shorts listed in the swap dealer category alone. Yes, this 336 tons that insiders do not want to deliver on these longs, they're so busy squaring up what they can before the end of the fourth quarter. It's that simple. And that is, guess what? And I don't want to spill the beans until I can about Russia's participation as we move into January. But under the very short-term COMEX-driven speculator-reliant gold capping efforts, which we also feel are an ill-advised official Russia oil for gold sanction pushback, wholesale market footprints reveal that every single first-year LBMA bank is positioned long for 2024, and the unfactored Russia Sino demand is now on their radar too. And the Fed is the only central bank still on the wrong side of the gold trade. And while they have managed to stick the bulk of this month's naked short or last month's naked short liability onto the specs into the end of the third quarter, that trade not only looks to be at its structural limits, but it has also opened up the paper market to a massive central bank demand not seen since November 2022. Now, we see a very close parallel to when the Fed sold paper gold, just as every single bullion bank, including the BIS, went long physical gold against the Fed, evidencing gold bottoming last November at 1,618. So in summary, every insider is accruing physical gold. Every spec rinse is being capitalized on by central banks and bullion banks for their own book. The only question, guys, is how much physical do you own?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our entire Live from the Vault community, buy physical. Make sure it's backed 1-to-1 and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. So there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Now, keep spreading the word about this channel. Get this word out. Hit the subscribe button if you haven't done so. And also hit that bell right there if you want to be notified every time an episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.